Currency printing, the most tangible and literal form of money printing in the fiat currency system, involves central banks such as Federal Reserve in the United States or the European Central Bank, or called as ECB in the Eurozone, or the Reserve Bank of India, producing paper currency and minting coins to introduce new money into circulation. This process, while only a small fraction of modern money creation, plays a critical role in maintaining the supply of physical cash necessary for everyday transactions. Replacing worn out currency and supporting economic activity, understanding the mechanics, purpose, and the implications of physical currency printing provides insight into how fiat money systems function and their broader economic impact. At its core, physical currency printing is the process by which central banks authorize the production of banknotes and coins to serve as legal tender. In the United States, for instance, the Bureau of Engraving and Printing, an agency under the Department of Treasury, handles the production of paper currency, while US Mint manufacture coins. Federal Reserve, as the central bank, determines the volume of currency needed based on demand from commercial banks, which distribute cash to businesses and consumers. Similarly, in the Eurozone, the ECB coordinates a national central bank to produce euros, while printing and minting facilities spread across member states. This process ensures that economies have sufficient physical currency to facilitate transaction from small retail purchases to cash-based savings. The decision to print physical currency is driven by several factors. First, the central banks aim to replace damaged or worn out notes and coins which deteriorate over time due to handling and environmental factors. For example, low denomination bills like a US $1 note have short lifespan compared to higher denomination notes, necessitating regular replacement. Second, central banks respond to changes in economic demand for cash. Seasonal spikes such as during holidays where consumers increase cash spending, or unexpected events like financial crises where trust in digital system wanes, can prompt higher security production. Third, central banks may print new currency to meet long-term economic growth, ensuring cash supply aligns with expanding economic activity. However, unlike digital money creation, methods like quantitative easing, physical printing is typically a reactive process, responding to immediate needs rather than proactively driving monetary policy. The mechanics of physical currency printing are meticulous and secure. Modern banknotes incorporate advanced anti-counterfeiting features such as watermarks, holograms, microprinting, and special inks to protect the integrity of the currency. For instance, the US dollar bill features integrate design and security threads that come under ultraviolet light. Coins, meanwhile, are stuck from durable metals like copper, nickel, or zinc to ensure longevity. Central banks and their printing agencies invest heavily in technology and oversight to prevent fraud and maintain public confidence in the currency. Once produced, new currency is distributed to commercial banks through central bank vaults, entering circulation as businesses and individuals withdraw cash. While physical currency printing is the most visible form of money printing, its role in the broader money supply is limited. In modern economics, physical cash represents only a small percentage of total money printing, typically less than 10% in advanced economies like US and Eurozone. The majority of money exists as digital entries in bank accounts created through lending and other central bank policies like open market operations. For example, in 2023, the US M1 money supply was approximately 18 trillion, but physical currency in circulation was only about 2.3 trillion. This disparity highlights that physical printing is just one tool among many in the fiat money system. The economic implications of physical currency printing are nuanced. On one hand, producing new cash is necessary to maintain the functional economy, ensuring liquidity for cash-based transaction, particularly in sectors like small businesses or informal markets. In developing economies or regions with limited digital infrastructure, physical currency remains crucial. On one hand, excessive printing without corresponding economic growth can contribute to inflation as oversupply of money chases same goods and services. Historical examples like hyperinflation in Weimar Germany or Zimbabwe illustrates the danger of unchecked currency production. Though these cases involve broader monetary mismanagement beyond physical printing alone. In modern, well managed economies, central banks carefully calibrate physical currency issuance to avoid such risks. Physical currency printing also raises questions about the future of cash in an increasingly digital world. With the rise of digital payments, cryptocurrencies, and central banks, also called as CBDCs, the demand for physical cash is declining in some regions. For instance, countries like Sweden have seen sharp drops in cash usage, prompting debates whether physical currencies will eventually become obsolete. However, cash remains resilient due to its universal acceptance, anonymity, and reliability during power outages or technological failures. Central banks must balance these trends, ensuring physical currency remains available while exploring digital alternatives. In conclusion, physical currency printing is the most straightforward and tangible method of money creation in fiat system, involving the production of banknotes and coins by central banks to meet economic demands. While its role is smaller than digital money creation, it remains essential for maintaining cash-based transactions and public trust on the monetary system. By carefully managing the supply of physical currency, central banks like the Federal Reserve and the ECB support economic stability even as the world shifts towards digital finance. As technology evolves, the interplay between physical and digital money will shape the future of fiat currency systems.